You just took a loss. It wasn't a big loss. It wasn't even a bad trade. Your setup was clean, your entry was precise, and the market simply moved against you. That happens. You know that. But something inside you shifts. A quiet voice says, get it back. One more trade. Just one. You'll make it quick. And that voice has destroyed more trading accounts than any bear market in history. If you've ever felt that pull, that burning need to jump right back in after a loss, then this video might be the most important thing you watch all year. Because today we're going to break down exactly what revenge trading is, why your brain is wired to do it, and how the greatest traders who ever lived learned to stop it. Mark Douglas, author of Trading in the Zone, put it best. He said, the market doesn't owe you anything. It doesn't care about your last trade. It doesn't know you exist. But when you revenge trade, you're operating as if the market personally wronged you. And you need to settle the score. This is not trading. This is ego management disguised as market participation. And it is the single most expensive emotional pattern in all of trading. Douglas spent decades studying why intelligent people make irrational decisions with money, and his conclusion was startling. He said most traders don't have a strategy problem. They have a belief problem. They believe the market should behave a certain way, and when it doesn't, they feel betrayed. That sense of betrayal is the seed from which revenge trading grows. Here's what happens in the brain when you take a loss. Your amygdala, the part of your brain responsible for fight or flight, fires up. Cortisol floods your system. Your prefrontal cortex, the rational decision maker, gets suppressed. You're now making decisions from the same part of your brain that would help you run from a tiger. But you're not running from a tiger. You're staring at a chart, and you're about to size up 3 times your normal position on a setup you didn't even plan. Neuroscientists have studied this exact pattern. They call it an amygdala hijack. Your emotional brain literally takes over the controls from your logical brain. And the scary part is, you don't even realize it's happening. You feel sharp, you feel focused, you feel like this next trade is the one, but that feeling of certainty, that's the cortisol talking. And there's another chemical player in this story that nobody talks about: dopamine. See, every time you win a trade, your brain releases dopamine. It feels incredible. That rush of being right, that hit of profit. Your brain remembers that feeling and it wants more. So when you take a loss, your brain doesn't just register financial pain, it registers a dopamine deficit. You're literally in withdrawal. And what does your brain tell you to do when it wants more dopamine? Take another trade. It doesn't matter if it's a good trade. It just wants the action. It wants the possibility of that next hit. This is why revenge trading feels so urgent. It's not greed, it's neurochemistry. Your brain is treating the market like a slot machine, and just like a gambler who keeps pulling the lever, you're not making decisions anymore. You're feeding an impulse. Jesse Livermore, one of the greatest speculators who ever lived, lost his entire fortune. Not once, multiple times. And every time the pattern was the same. A loss would sting his pride. He'd try to make it back immediately. He'd abandon his rules. He'd trade bigger and faster. In Reminiscences of a Stock Operator, he wrote something that every trader should tattoo on their forearm. He said, "The desire to always be in the game is one of the speculator's greatest hazards. It's not the market that bankrupts traders. It's the inability to stop trading when your mind is compromised." Livermore made and lost the equivalent of billions in today's money. And at the end of his life, he said his greatest regret was not the trades he lost. It was the trades he took when he knew he shouldn't have. Let's look at the math, because the math doesn't lie. Say you start the day with a $10,000 account and take a clean loss of 2%. That's $200. Manageable, within your rules. But then you revenge trade. You take 3 more trades, each at double your normal size, each with a wider stop because you're now chasing. You lose on all three. By the end of the day, you're down 12%. That $200 loss just became $1,200. It will now take you a 13.6% gain just to get back to where you started this morning. But it gets worse. Do this for a week and you're looking at a 30 to 40% drawdown. At that point, you need a 60 to 70% gain just to break even. That's not a bad week. That's months of recovery. Some traders never come back from it. The math of recovery is brutally asymmetric, and revenge trading exploits that asymmetry every single time. Paul Tudor Jones, the billionaire hedge fund manager, has a rule that most traders know, but almost nobody follows. He says, if I have positions going against me, I get right out. If they're going for me, I keep them. He doesn't try to be right. He tries to minimize damage. The difference between a professional and an amateur is not their win rate. It's what they do after a loss. A professional takes the loss and walks away. An amateur takes the loss and doubles down. Jones has been trading for over 40 years. He survived every crash, every crisis, every black swan event. And he'll tell you his secret is not some magical indicator. It's emotional discipline. It's the willingness to accept a loss and move on without needing to even the score. So how do you actually stop revenge trading? The first step is recognizing the trigger. And the trigger is never the loss itself. The trigger is the story you tell yourself about the loss. I should have known. That was obvious. I can't believe I missed that. That internal narrative creates shame, and shame demands compensation. Your ego needs to restore itself. Trading feels like the fastest way to do that, but it's actually the fastest way to deepen the wound. Here's what most people don't understand about this cycle. The shame doesn't come from losing money. It comes from feeling stupid, from feeling like you're not good enough. And that feeling has nothing to do with the market. It's something you brought to the screen with you. Until you understand that, you'll keep making the same mistake. Let me tell you about something called tilt. Poker players know this term well. Tilt is when one bad hand turns into 5. It's when you stop playing your strategy and start playing your emotions. In poker, a player on tilt will call bets they should fold. They'll bluff at the wrong time. They'll chase hands that have no business being played. Sound familiar? In trading, tilt looks like this. You take a loss. You immediately enter a new position. That one goes against you too. Now you're angry. You size up. You move your stop. You take a third trade in the opposite direction because surely the market will reverse. It doesn't. By the time tilt is over, you've taken 6 trades in 2 hours. None of them were in your plan, and you've lost more in one session than you normally lose in a month. Here's a practical framework that some of the best traders in the world use. It's called the 2-loss rule. After 2 consecutive losses in a single session, you stop. Not because 2 losses means your strategy is broken, but because 2 losses means your emotional state is now compromised. Seykota, the legendary trend follower, said, "Win or lose, everybody gets what they want out of the market." If you keep trading after 2 losses, ask yourself honestly, are you trading to make money? Or are you trading to feel something? The 2-loss rule is not a limitation. It's a superpower. It protects you from yourself on the days when you need it most. The best part? It's binary. There's no judgment call. 2 losses, you're done. Walk away. The second tool is what I call the physical circuit breaker. When you feel the urge to revenge trade, physically stand up. Leave the room. Set a timer for 15 minutes. Go outside. Drink water. Do push-ups. It sounds absurd. But remember what we said about cortisol and the amygdala. That response takes time to dissipate. You cannot think your way out of a neurochemical reaction. You have to give your nervous system time to reset. 15 minutes is usually enough for the prefrontal cortex to come back online. Some of the best proprietary trading firms in the world actually enforce mandatory breaks after losing streaks. They don't do it because they're soft. They do it because they've seen the data. Traders who step away after losses have significantly better results than those who push through. The third tool is something I want every trader watching this to start tomorrow. Before your trading session begins, write down 3 things. 1. What is your maximum loss for the day? 2. How many trades will you take maximum? 3. What setups are you looking for? That's it. 3 lines on a piece of paper. This is your pre-session contract with yourself. And here's the key. Write it by hand, not on a screen. By hand. There's research that shows handwriting activates different neural pathways than typing. It makes the commitment more real, more physical. When you write, "I will stop after losing $300 today," your brain processes that differently than if you just think it. It becomes a promise. And breaking a written promise to yourself feels very different from breaking a thought. The fourth and most powerful tool is the trading journal. Not just writing down your entries and exits, but writing down your emotional state before, during, and after every trade. Rate your emotional clarity on a scale of 1 to 10 before you enter. If it's below a 7, do not trade. This sounds simple. It is simple, but it is not easy. Because when the revenge urge hits, the last thing you want to do is pause and write. And that resistance, that is exactly how you know you need to. Over time, your journal becomes a mirror. You'll start to see patterns you never noticed. You'll realize that your worst losses always happen on Mondays, or after you check social media, or when you trade a certain instrument. The journal doesn't just record your trades, it reveals who you are as a trader. And that self-knowledge is worth more than any indicator or strategy. I want to leave you with something that changed how I think about losses forever. Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world, has a principle. He says, pain plus reflection equals progress, not pain plus revenge, not pain plus more trading, pain plus reflection. Every loss is information. Every loss is data, but only if you're calm enough to read it. The traders who survive, the ones who actually make it in this business, are not the ones who never lose. They're the ones who learn to lose well. Think about that. Learning to lose well. It sounds counterintuitive in a world that celebrates winners, but in trading, the ability to take a loss with grace, to walk away, to reflect, and to come back tomorrow with a clear mind, that is the edge. That is the trader's edge. And it's the one thing no algorithm, no indicator, and no strategy can give you. You have to build it yourself.